There we go. Hello, everyone, and welcome to the Thursday, April the 4th edition of the Scientific Governance and Risk meeting with MakerDAO. We have a lot of people on the call today, and we have a lot to go over. So I am going to speed through my preamble as quickly as I possibly can. We're enormously interested in as much feedback as we possibly can get in these calls. We have a limited amount of time, but we have a standing room only group of extremely smart people in here, and we need to hear from you guys. So we're going to speed through stability fees. We're going to talk about the PEG. We're going to talk about some analytics, and we're going to talk about risk, and then we're going to open it up to a Q&A session towards the end. But my job for now is going to be to hand it over to Stephen Becker and click the admit button while he's talking. So Stephen, it's all yours.
Thank you very much. Firstly, thank you very much, everyone, for joining. Again, just to recap, what we try and do in these calls is cover basically three themes. I know we've heard it before, but this is something if we can just get used to, it's a lot easier to understand the context and the objective of these calls. The first theme to consider, and that's something that we will do today, is the demand and supply dislocation. The second would be collateral types, collateral portfolio, and parameter adjustments with respect to that. That would be the second theme that we'd be looking at. And the third would effectively be exogenous risk, things that are outside the system, but obviously affect us directly. These calls are centered around those themes because I believe that those themes cover the entire spectrum of risks that we need to consider. So again, we remain focused today on the demand and supply imbalance. We're going to have a look at where we are with respect to that and get some sense. But please remember that decentralized scientific governance, which also includes the stability fee, are considered and facilitated by this call. But ultimately, the decision is made by MKR governance. This is very, very important. And also keep in mind that governance is a continuous function, so please be involved as much as possible. And with that being said, I'll hand it back over to Rich.
Yeah, and that was a great segue, actually, because that's precisely what I want to talk about today. Governance is a continuously evolving process at MakerDAO. I'm heartened by the fact that every time we go through the process, we've improved it. One of the things that we've identified, or the community helped us to identify in the last call, was that we need to understand community expectations about polling. Particularly, especially with the variability of the stability fee recently and our renewed attention towards the maintenance of the PEG. So what I want to do today is explain a bit about how this process has looked in the past, talk about a couple of the challenges that we're looking at, and I really want to get as much input from the people here about how they would like to see that process changed and how we can tighten up the polling and the executive vote mechanisms. So here's the general picture of the way that things have been working previously. We have a community call, and in these calls we talk about the data that we've seen. We talk about the look at the data and try and figure out where the market is going to be in the future, how that's affected the PEG in the past, and some next steps that we need to take. We hash that out a bit, we share graphs, and then we are wrestling with this idea of coming to a consensus for signaling in these calls. And I think that there's still some ambiguity there, at least there is in my mind. And the way that we've done it previously is we've decided as a group, or the community has come to us and said, we need a poll, and we need to discuss, we need to put a range of stability fees in front of the voting stakeholders and have them signal which one they are most interested in seeing. Then we have an executive vote, which all sounds fine and it's worked out well so far. But the problem that we're having internally and externally is that there's a significant number of steps and stakeholders and overhead involved with that process. And what we've been doing behind the scenes at MakerDAO for the last few weeks, is spending a great deal of time and effort trying to audit that process to figure out exactly how many steps are involved with determining that there is something that needs to be addressed by the community, and ultimately having a vote and then publishing the results of those votes. And I have a document here that we've been playing around with that shows that there's around 37 individual steps, handoff steps, from determining that we should do something to actually doing it and then publishing the results. There's a lot of different departments involved. There's a lot of different stakeholders and sign-offs required, and that's just internal to MakerDAO. It doesn't include things like having these calls, summarizing, transcribing, uploading the audio and video, talking about it on Twitter, setting up a Reddit thread to discuss the issues, maintaining the polls, having a call about the results of that poll, and then having an executive vote, then publishing the results of those executive votes. Anyway, so that was a long-winded explanation of some of the challenges that we're trying to address inside the organization. And one of the things we've begun to discover is that for MakerDAO to remain, the foundation, to remain flexible enough to facilitate these votes in a reasonable time period, it seems like 7 days is probably the sweet spot for us. And so the thing that we're thinking about is we, as a group, as a community, determine that there's a change to the stability fee that's required, and we set up a poll to figure out what the community thinks that change should be. We wait for them to signal their changes over the course of 2 days, I think is probably a number that we can start off with as a baseline. Then we have a call to review that community signal. And then the next day we have an executive vote, and that'll probably be on Friday, and we'll wait. Traditionally, I think that we've seen this takes like 10 or 12 hours for the community to stake their maker on one side or the other of an executive vote, which is really nice. And then that gives us the opportunity to spend the next week either evaluating the effects of that change or potentially having another poll. And so here's where some of the ambiguity comes in, or some of the complexity comes in. We need to determine whether we are all comfortable with this wait and see periods after these polls, or whether it would be better to do something new, and that new thing would be the possibility of having continuous polling. And that's an option that I want to put in front of the community right now. So I know that I've kind of rambled a bit, and I've been slightly all over the map, but we need to determine, or we need to find out what the community wants in terms of polling mechanisms and polling cadence, I think. And what we've seen some suggestions in the subreddit that vary between not between, it's not binary, there's a spectrum here. So people will see that the peg has drifted and they want an immediate change, and other people just have a general feeling of what they think a stability fee change should look like, and they want to see a poll for that. And there are other people that have are of the opinion that there should be just a weekly poll of whatever 50 basis points or 100 basis points. And what I really would like to hear today from the community is some of their suggestions and some of the feelings and some of the reasoning behind what kind of cadence they would like to see for these polls, and what kind of ranges we would present, and how often. Maybe I can leave it there, because I know that was a bit of a data dump, but I'm sure there's people on this call that have strong opinions about it. So if you want to type them in the chat and let us know what those opinions might be. Also, feel free to jump in at any time and interrupt, because
Rich,
it's all about hearing from people. Yeah.
Can you define this idea of continuous polling? Is it just what you said, where there's a 0.5 on the table every week, or is it something else? I just want to make sure I understand.
Sure. Yeah. Let me give you some context there. So the thing that we need to work on internally and externally, I guess, is agility and velocity on accepting signals from the community. And right now, I alluded to it earlier, but there's so many different steps and processes involved to get a new poll in front of the community that it sort of involves doing the same work every week, which is onerous. So there's another option on the table, and that option could be that every Monday a poll just goes up automatically, semi-automatically for the near term. And I think the option is that some people have suggested that 50 basis points every week, and just see what the community thinks about that. And I want to throw a bit of a curve, or add some complexity to that, though, because I don't want to get into a situation where we assume that the current picture of the market is the one that we're constantly living with. So we're not always going to be considering increasing the stability fee, and we're not always going to be considering increasing it by 50 basis points. So one of the questions I wanted to put in front of the community was this idea that if we do have a weekly poll, it could provide a range. So anything from negative X basis points to positive X basis points, and judging by community interest, the state of the ecosystem, and the peg, we can watch for signals that either people want it to go up, they want it to go down, or they want it to stay the same. So does that provide enough clarity, Chris? Does that explain what I'm thinking about?
That's clear to me. So the question in there, I mean, it does get quite complex so if it's 50 bips up, 50 bips down, thumbs up, thumbs down once a week, or stay constant, 3 options, seems like enough to consider on a weekly basis. Having a sliding scale where that could be, as high as, well, we've gone as high as 4 and all the way to negative 4%. Changes each week, and then deciding how big that range is on a week-to-week basis feels complex to me, and feels like the kind of thing that we might want to do more ad hoc as opposed to having a specific rule preset. But that's just my initial reaction.
Yeah, and those are some of the questions that we've been wrestling with as well. So I want to make sure that people understand that I'm not proposing anything. I'm reiterating some options here, and there's pros and cons with each side. One of them is engagement exhaustion, which is something that we need to seriously consider, that not everybody is going to be prepared to keep track of the market and signal, set aside time every Monday to do the research and signal appropriately. That kind of thing has a tendency to have some significant commitment drop off. The pro side of this kind of an idea, I think, is that we don't need to coordinate efforts to respond every time we see the market deviating or the peg deviating. And there's that lag time that we've been dealing with. Does it take a week for us to determine that something needs to be addressed? Can we turn it around in a day? Does it take 2 weeks? So those are some of the things that we're worried about.
Rich, do you mind if I throw a kind of a wrench in this whole thing at the moment? Because it seems like there's a huge constant... and rightfully so, it is one of the major mechanisms, like dependency or go-to for the stability fee. And the more I've thought about it, the more I come to the idea that we might want to, if this is feasible, I don't know. I talked to Cyrus very briefly about it, and I haven't had a chance to write it up on Reddit or in general. But there seems to be just this time dependency mismatch, and coupling that with irrational human behavior. Humans are just terrible at rational behavior in the face of delayed punishment or gratification, prospect theory, risk assessment, future cost discounting stuff. And when you couple that with this unknown information distribution across the community of CDP holders and unknown information uptake of that community, and it might be that something new or drastic or different is needed to bring the price expectations of DAI in line with the supply changes. Because we've seen supply changes, but haven't seen that follow through to order quantity and execution on the exchanges. So something that randomly came to my head was having an auction for people who hold Maker to quote unquote trade some of their Maker as an incentive to give CDP holders.
It seems very complicated. Doesn't that seem overly complicated though?
Oh yeah, no, this is just something, there's tons of different things though that I'm saying. Yes, that specific example certainly seems complicated because there's a lot of infrastructure we'd have to build and think about. But the general point is the stability fee might not be sufficient to drive the conversion and thus the price appreciation and tracking that I think the community is going for.
Yeah, I love actually everything you said. So I think that we probably share some ways of thinking. So I think we all know that crypto is not rational. the crypto market is not rational. People's responses to it are not rational, and so there's definitely a concern to be there's something to be considered with, do we just expose this lever that any sort of panicked group of people can just start signaling for based on whatever the market did that day, right? And you also touched on this idea that we're, I think, as a group becoming more and more familiar with, is that there's no immediate cause and effect between a stability fee change and the way that the market reacts, or the way that the inventory responds to those things. I think that Matthew, is he in the call? There's been some really good posts in the MakerGov subreddit about the elasticity of demand that we're seeing here. And
Yeah, I read that one from last week, and that's definitely kind of like in part of the picture of what I was talking about, for sure.
Hey, can you guys, or Rich, can you specify if you're thinking of this more as like a long-term problem and solution, or something that you want to implement right now? Because, you know, it just seems like for now, like whatever extra work we have to do to bootstrap or get things going, you know, not really a big deal. Like I don't see voter apathy as a huge issue right now because everybody's kind of engaged. Are you thinking more of trying to find, like, I mean, obviously there's a lot of talk about like, why can't we just do an automated change to the stability fee every week by whatever? I mean, that's not, you just I think we should be clear on if we're thinking long-term, or we perceive it to be an issue today and we need to cut down those 37 steps today because we're running into issues with actual, you know, managing things.
Well, those are all great questions. And so let me clarify one thing. I'm not proposing anything. I'm trying to condense and refine the ideas that I've been seeing in chats and socials and Twitters. I think there's something to be discussed here about a continuous poll. I'm not sure whether that's a good idea or not. That's what I want this block of time that we've allocated in the call to start exploring. I'm not sure. Those are great points. Like, this picture that we see ourselves in right now is not the picture that we're always going to be in, right? The market shifts, the multi-collateral DAI comes out, all kinds of things change. So maybe the cognitive overhead, cognitive load of a weekly poll is potentially worse than the lack of flexibility with having to wait 2 weeks before the next poll comes along, or a week and a half. So, I don't know.
But it seems like this is also just, you're always going to run into this problem of, you might be using the old Fed analogy, you know, pushing on a rope, where you can do all of these things excellently. You can create this whole infrastructure for the stability fee changes, but then the stability fee changes don't have the impact that you want them to have on the target price. So I think, like, if you're going to spend a lot of resources right now, the allocation of those resources shouldn't necessarily, and this is just my thought, I could certainly be wrong and not, you know, convinced of this either way, but this is just where I'm at right now. The allocation of those resources right now should probably be better spent on understanding how the market is acting with respect to DAI and CDP closures and borrowing and wallet movements and leverage and all this stuff, so we can have a better picture to frame this discussion in.
Yeah, and that's something we're actively working on. We've put together a small but dedicated group of community volunteers to form some sort of a volunteer risk group, working on kind of sourcing data, curating it, open sourcing it for the community. We're engaged with a couple analytics firms, a couple chain analysis firms to kind of paint the overall picture of DAI and what it's being used for, you know, demand, supply, everything about CDPs. So we are expending resources on kind of a base case of data that will help for anything we want to do with it. But I think even beyond that, we still have to deal with the governance aspect as well. In my mind, it's kind of two distinct issues.
So I have a question. Like, does anyone disagree that the stability fee should not be raised right now? Because that seems to be something that we haven't really talked about just yet. And maybe that's coming at the end of this, but it just seems really important to me. Yeah.
We're going to segue almost immediately, the next minute or two, into the risk presentation from Cyrus, and then we'll get into that. So I'm not sure that we're going to find a clear consensus on the cadence, rate, and the utility of continuous polling right now. But what I want to do is I'm going to post a link into the chat here. This is the discussion for this call that I'll be posting the transcripts and the audio and video of the call too as well. So if anybody has thoughts that we don't address in the hour that we have today, please add those to that MakerGov thread, and we'll continue to hash this thing out.
Yeah, I think this is a great discussion to have on the MKR.gov subreddit. I mean, typically so far it's just been about kind of DAI price and stability fee adjustments, but I think it's time to kind of broaden that scope out a bit because it's important.
Yeah, I agree, and we're iterating a bit on the process. So in the future, we'll be having these discussion threads a day or two prior to these calls, where we'll do a better job at actually explaining exactly what the calls are going to be about, giving people an opportunity to do some research and form some opinions before we get here. And then we'll have the call, and then we'll continue the discussion in the thread. Hopefully that'll give us everyone an opportunity to prepare and formulate some ideas ahead of time. Okay, so I'm gonna let that go there. So to recap, we as a group, we need to figure out how we handle signaling. What signal do we use to determine we need a signal? So what I mean by that is, how do we, as a group, as a community, figure out that it's time for us to have a governance poll, and how does that governance poll get kicked off, and what's the cadence of that poll? And so those are all outstanding questions right now. So if you have ideas, thoughts, or proposals, please add them to that thread that I just linked to. Cyrus, I'm going to hand things over to you right now for the risk segment. So if you want to tell us about the state of the peg, and we can move on from there.
Sure. Give me 1 second. All right, so this is the DAI price over the last week. I mean, when we were speaking last week, it was kind of hovering around 98 cents, and we had seen a bit of an uptick from the prior 4% increase. I think people were feeling pretty good when we were on the last call, but then I think immediately after, like, peg kind of started to weaken again, back down to the 96 range. And I think, you know, a bit disappointing for sure. And then, you know, last 2-3 days, we had some fairly extreme market volatility, which, you know, provided some interesting things to think about. So contrary to what we had seen in the past, we did not see DAI weaken on the rally, but in fact, we saw it strengthen back up to the 98 range with a fairly decent volume too. So we don't have volume on this chart, but well, kind of hard to see, but we did see some, you know, significantly higher volume with the market volatility, and it's definitely kind of hovering in the 98 cent range. So let's look at the CDP stuff, and then we'll come back to that in a moment. So a couple things. We saw, you know, this huge pink bar. Obviously, we saw a lot of wipe activity as the market rallied, as people were basically taking profits. That's essentially the component that we hadn't seen over the past few months, where on the, you know, typically on the rally, we'd seen speculators kind of trying to momentum trade this and keep drawing DAI and levering up and trying to go with the market. I guess, you know, Tuesday's huge rally kind of pushed a lot of speculators to close out and take profits. That being said, we did also see a significant number of draws as well. So the total reduction in DAI over the last few days wasn't actually anything meaningful. It kind of balanced out. Over the past week, we've seen fairly stable DAI supply. That's that yellow line. You know, so I mean, for me, the main takeaway here is that there's definitely some conflicting components here when it comes to the relationship of DAI supply, DAI price, and the ETH price. Definitely going to require some more granular analysis in
Cyrus,
to come. Yeah.
Can you click the ETH price on that chart?
Yeah, sorry about that.
Yeah.
Yeah, this pink bar is where we saw the big ETH rally. Yes, I mean, I think the main takeaway was that, you know, speculative behavior is obviously dynamic. We can't kind of always rely on those same assumptions. Yeah, I mean, I think there's a lot to talk about, but for now, let's just kind of open it back up to the community, I think, and see what people think.
Generally speaking, what would you expect people to do at different, I don't know if you've studied this or not, at like different daily or weekly price change percentages on Ether? Like, because I can see the story going full circle where you have like one part of it, you know, basically like starting over. So like price goes up, people want to close out positions, but at the same time, you have people believing the price will continue to go up, so they open positions. Have you like looked at how that plays out over different percentages of changes?
I mean, that's like an incredibly complex question. And I think drawing a comparison from, I think Bitfinex and BitMEX, or I know Bitfinex definitely posts their kind of longs versus shorts statistics. And I know those have been heavily studied over time, and people are always trying to figure out at various price points, are people going to, you know, basically go one way or the other. And as far as I know, when I've looked at that stuff in the past, it has been fairly unpredictable. You know, trying to use speculators, you know, the price points where they enter and exit into positions is not very predictive, in my opinion. So I think trying to guess, okay, if ETH goes from 160 up to 200, if that's going to, you know, inspire people to cover or go to lever up long even more, I think is going to be fairly difficult, if not impossible.
Cyrus Vishesh brought some more graphs for us today. Do you want to do a quick screen share and have him walk us through those?
Sure.
All right, Vishesh, if you want to take it away for a second.
Sure.
Who's doing the screen share, to be clear?
Vishesh.
Okay.
I'm interested because I think there's going to be some interesting data in there about competing loan platforms and seeing how that affects us.
So just a quick update of what's new since last week. So this is the same DAIETH VWAP price graph with the trading volume as well. So just as Cyrus had mentioned at the beginning, there have been some spikes in trading volume in the last couple of days, which is good to see. The other interesting thing, which I noted when I just sort of looked at ETH price as well, is that volume actually kind of seems to track a little bit with the fluctuations in ETH price, and this has been like a long discussed topic, I think, and the correlation is decent, and I can look at the correlation graph next time, but not super strong. It's just kind of the relationship of ETH price and DAI price. So, you know, you'll note that as the ETH price has kind of come up a bit and held steady in the past month or two, what's interesting is the supply has not changed that much, but as you can see here on the transaction volume graph, which was what Cyrus was alluding to a second ago, though the supply has not changed much, there was, you know, a huge spike in transaction volume, which is, from my understanding, from a big kind of offsetting effect of people doubling down on draws and wipes respectively. So I'm not sure the reasoning behind that, in terms of perhaps people who are long on ETH are just sort of upping their amount of leverage, and then people who are kind of worried about the stability fee or starting to feel some of the pain of keeping large outstanding debts decided to sort of take some of those profits and pay down their debts. And then what Rich was mentioning a second ago in terms of the interest rates. So what's interesting is we can see the compound interest rate had come up a little bit in the last few days, but really not as much of an increase as I would have expected. Let me zoom in here for a second. So you can see it had upticked a little bit, but really not the level of increase that I would have expected to see, which is interesting. I know there was some discussion on the chat in this call about looking at this compound interest rate as somewhat of a guiding factor for how much we should be increasing or decreasing the stability fee by. And I know there was some discussions last week around sort of the DIPOR and all of that. And that's a topic that I'm sure we'll explore a little bit further. But it is interesting that unlike in the past, this time when we sort of jacked up the stability fee, there was not a huge change in the compound DI interest rate. The other thing was the loan volume was really interesting in the past week or so. So there was, a sort of slow and steady increase in the amount of DI being supplied, which I think does tend to make sense with the increasing ETH price. But the borrow volume also spiked before we saw a tremendous increase, which was kind of interesting in the sense that there was an impact on demand, I think, that this is an indicator of. So even though I kind of expected the increase in the stability fee to have somewhat of a dampening effect on demand, as well as a dampening effect on supply, both had seemed to kind of run up, which was another sort of unexpected data point. Not much to say in terms of the distribution of draws and wipes and bites, respectively. Actually, it's been fairly well distributed for the past couple months. Not very many bites, as you can expect, but that's mainly as a function of ETH price. And then the sizes of the CDPs that we've been seeing some of these wipe transactions on have actually been fairly well distributed. There was a little bit of kind of clustering of some big CDPs that had wiped down some debt, but really not enough of a skew to really make any conclusions off of.
That's all. There's a lot to digest there. That was just really interesting, though, and I hadn't considered using the CDP size as a weighting of potential sophistication of the user. Is that what you're doing with that, Grant?
I had looked at that as one factor. So I had kind of looked at just pure wipes, and then I tried to see if maybe there was some sort of skew across whether large CDPs were getting wiped down or small ones, but there wasn't a huge conclusion from that. It seems pretty evenly distributed.
It's something to watch, though. That's really interesting. All right, thanks, Vishesh. That was great. There's a lot of chat in the sidebar here. David, is there anything that should be brought to the community's attention? Is there questions we can be asking?
Not particularly relevant to all the data and stuff. Ashley had an interesting suggestion about bond.
Cool, no worries. So basically, his suggestion was, given the flat DI supply this last week, we sort of kind of maybe equilibrated in terms of the DI supply, especially in the face of the market rally. So, if there's an assumption that, with the current stability fee, we're not going to see any significant deviation from this rough 88 million DI supply, then potentially all we need to do is just kind of soak up the static excess reserve. So basically trying to soak up whatever is needed to get from 98 cents to $1. Potentially that's a relatively fixed number. So under that context, he was recommending very small and steady, I think, 0.5% stability fee increases, up until, every week or every cadence until we see that excess DI soaked up. So that's one option.
So I'm curious if you guys have kind of like reached out to some of like the competing like lending platforms and kind of seeing like the rates, like for example with Genesis or Cumberland does lending, and if you're looking to get some size, I would say like we are still extremely cheap compared to to some of our competitors. And my personal opinion is that, making sure that there's like a gradual kind of increase and not, screwing the pooch, so to speak, with too high of a stability fee is definitely appropriate. But I think we should all like come to consensus on this call, hopefully, that like we may need to be a little bit more aggressive with rates, just looking at who the competition is and what they're currently, what the borrowing costs are for people using those platforms.
Yeah, that's a great point, and that's definitely something we've talked about looking at, both kind of the OTC lending desks, but also margin rates across various exchanges. That's actually stuff we have data for some of that already. Just haven't found a way to output it yet. Yeah, that's a great point. We definitely should be looking at stuff like that though, on a weekly basis. So to be clear, are you saying we do need, in your opinion, we need a fairly large increase in your mind if we were to if there were to be a governance pool?
Well, it depends on what the cadence is, right? So if we can all come to agreement that for the next 4 weeks, we are going to raise the stability fee by 1% each week, or whatever kind of, whatever you guys think is more appropriate, then I think that's probably fine. But if we're not going to make a commitment to doing that, then I would much rather prefer being super aggressive in this regard to try to get the peg back to parity, because there has been very little activity at $1 and above $1, other than some errant trades, it would seem, on some of the non-custodial exchanges.
That's a great. I want to jump in super fast and just comment on that, Chris. One of the things that we've been wrestling with for a while now is this concept of forward guidance, and if we begin to if we set out a regular schedule of increases over a period of X weeks, or we just as a community determine that this is going to keep on happening, that does serve as a signal to the rest of the market that we're all serious about this thing and it's going to continue to be increased, which might have an effect. So that's also something to consider when we decide on a schedule for these things.
And just out of curiosity, Chris and Rich and Cyrus, or anyone, please feel free to weigh in as well. If you had to take a position, would you rather have the DAI trading above $1 or below $1, assuming the distance is small?
Lev, do you have any thoughts on this?
Because my thought is that the natural state of the DAI, given the system, might be slightly below $1, kind of like.
Well, it's a function of interest rates, right? So right now, if I'm a trading desk, I'd rather take my money out and take my 2% and put it in CDs and put it in the bank. So that's until the DAI stability rate comes in. DAI savings rate comes in. It's tough for us to keep it at 1. But I think that if we move the stability fee up further, Chris and I don't agree on everything, but we agree on this in terms of going on and increasing it at a 1% or a 0.5% rate for the next couple of weeks. I think we should do that. So that's what I don't know, for what my opinion is.
Joe, do you want to talk about any sort of inventory or market making or things you've seen on the trading side in terms of activity? I think we skipped that part.
Chris kind of hinted at it, but we did get above 1 in some venues on the move up. So when people wanted to go and liquidated their, when they wanted to get out of their ETH, they came and immediately lifted to get it to DAI. So that happens because DAI is on really 30 venues. You really have, it's illiquid on. There's no venue that's really won out yet. And because of that, if a person wants to get out of $1 million DAI or really $250,000 DAI, they really have to lift up, and they lift up to 1, and that's what causes the spikes, temporary spikes up to 1. But I have seen there's plenty of bids down at 98 cents, 97 cents. So on the OTC front, but that's what over the past week, that's what's kind of been happening.
Hey, this is Matthew, and I've done a lot of market making over the last half year or so, mostly on ETH to DAI, and before that Oasis. What I've seen since February is we've never really had even moments where DAI was trading over a dollar, compared with the centralized exchanges, Coinbase Pro and Kraken. The price has pretty much always been, for the last 2 months, it's always been below a dollar, basing that on the ETH price. That's very different than what we saw in November, December, and January. So at this point, we know there's a really large inventory of DAI in the hands of market makers, including the maker market makers too. There's an extremely large inventory, and I think probably all the market makers would like to reduce the inventory of DAI that they're holding in exchange with things like Ether and other stable coins. So I think we need to be fairly aggressive and not just do like quarter point, half point here and there. I think we need to be aggressive and get the inventories down, because until those inventories are down, we're not going to have any real price discovery going on in this market. So that's my thoughts.
Yeah.
Okay, so that kind of circles us right back to kind of what I was talking about at the top of the meeting, is how do we start a signal to get a signaling pull out there? And I'm still kind of wrestling with that idea, but I think that we can maybe experiment with some of these ideas. So I've been watching the chat intermittently, and I've seen things from let's be slow and steady to we need an aggressive change in order to fix this thing. It's very confusing from my uneducated perspective, because I'm no financial genius, and so I don't have insight into the reasoning that goes behind some of these suggestions, and that's kind of where I get confused, I think. So figuring out what the bar needs to be, I think, when we do these changes is something we need to consider as a group. I think we should raise the fee is probably not going to be a super compelling answer.
Rich, I have a quick question for you.
Sure, just let me finish this one. But if we see suggestions, we need to raise the fee by X because of Y and Z, I think that's going to go a lot farther towards instituting some kind of a change here, some inertia.
I mean, this is something Volcker and Bernanke have studied extensively, and Greenspan to a lesser extent in just their general studies. And you definitely see market signaling being something that is of the utmost importance to the Fed. There's a lot of lessons that we could probably take from that. And one of them is, if you're trying to hit a specific target and you're not worried about, and you are worried about overshooting that target, it's more important to signal caution to the market than to signal aggression. But on the flip side, if you want to signal and you're not worried about overshooting and you just want to get control of a system, you can go like how hard Volcker did in the early 80s and not worry about overshooting on one side and signal aggression, and the market will be more likely to respond. And so if you want to put in place like a system of, we are going to do a 3% increase every single week until this happens, and you set that expectation, you will very likely get a supply significant decrease in supply. It might overshoot a dollar and you might overshoot, but if that is the goal, then I think that there's some lessons there from the Fed.
Well, I think we have been trying to signal that for actually a month and a half now, except instead of saying, as a community, we might do something every week, I think it's maybe been closer on the order of every 2 weeks, just because of the way our governance process works and kind of trying to let the market absorb our changes. But I mean, we have been fairly, it's
the consistency has been there, but the aggression has not been there. For example, like if you look at those rate hikes that Volcker did in the early 80s to get us out of the inflationary expectation spiral that started at ramping up with commodity prices at the end of the 70s, you'll see like he basically, there's not a pedal. He just went pedal to the metal. He raised short-term interest rates to unimaginable levels, like 24.5% on a 3-month Treasury bill. Like, that's a bonkers number looking back at it, but that's what was quote unquote needed to get the market expectation aligned with that, to get them in line. So the consistency is definitely there in terms of the signaling, but the aggression might be able to be ramped up, and the consistency of that expected aggression.
So we're coming up on 10 minutes left, and I really want to leave this call with some kind of a sense of direction. So let me recap some of the options that we're talking about right here. We're talking about the community sets an expectation for X% increase over Y weeks, and that is strong forward guidance for the rest of the ecosystem to understand. That's one option. The second option that we're talking about is we present basically a weekly poll with a range of options, and we allow people just to find what level they are interested in and deal with the pros and cons associated with that response or that process. The third option is that we can sort of continue along the path that we've been going down, where we try to identify a need, and then we get a poll up and running as soon as possible once we get some kind of a general consensus. So those are the three options that we're looking for. I don't know how we do signaling to figure out which signaling method we want. Like, do we want to do like +1s in the chat? Do we want to have impassioned speeches by people with microphones? Do we want to continue this discussion in the MakerGov thread? What are people thinking? Like, how do we make it?
There was also the suggestion of informal Twitter polls. That was also in the chat.
Is there a way to get a sense for the community's feeling about overshooting or not overshooting? Because I feel like that could actually drive how hard this should be pushed.
Well, okay, so let me chime in on that one. So, like, this is just my sense of it, is that the stability fee, when you start seeing the DAI price, the DAI supply not really changing, up and contracting and expanding, but more or less staying static, and we reasonably believe demand is materially lower, it was talked about a couple weeks ago, maybe it's 70 million. We need to raise the stability fee to the point where we have a linear reduction in that DAI supply, not exponential, like carrying a large cooking tray of water. It's really easy to tip it over if you just make too much of a shift off. We just don't want to have an exponential contraction of the supply, right? That's the reason in my mind's eye why it's important to just have a constant cadence of 50 basis points, 100, whatever the number is. But it's really the target of getting those two to mesh, but linearly.
That is an excellent answer to the question. Thank you. So basically, we want to avoid the conversion of a linear to exponential change in supply decreases. So in that sense, then yes, something where you say you're signaling to the market, that would be much more along the lines of Bernanke, Powell, Yellen, where you're looking at saying, this is what we are going to do. We are 100% committed to this set of actions until this happens, and set that expectation, and then follow through with that expectation every week, kind of thing.
From my perspective, I have no worry whatsoever that we, like, as far as overshooting the price of DAI, and we move up, or we have a significant contraction in DAI supply, and we move up above $1. I mean, these market makers have been out there accumulating tons of DAI for months now. The worst thing that happens in my mind, if we overshoot temporarily the $1 mark, is they get compensated for doing so, which doesn't sound like a bad outcome to me, but that's just my perspective.
Okay, that's interesting. So let's avoid exponential changes and look for linear aligns with that first option that's been discussed, where we set an expectation of X% over Y weeks. Am I understanding that correctly?
That's if you subscribe to the don't overshoot and don't risk exponential decreases in supply philosophy. If you believe, I can't remember the name of the person who just spoke, placeholder conference room. If you believe the placeholder conference room, then you would definitely do the opposite. You would say, let's do 5% this week, 5% next week, 5% the week after, until we see X.
But that's linear, that's not exponential, right?
Oh no, that would likely cause an exponential closure rate, because you're...
Oh, I see what you're talking about, the closure rate. Okay. I missed
right.
that.
Well, the market makers are sitting on an enormous inventory of die right now, and that they have not been able to offload any of that die for $1 for 2.5 months now. Even with spikes, they haven't been able to offload it. So they have a lot of die that they can supply for $1, $1.01, $1.02. I'm not really worried that we're going to have some catastrophic situation where die trades for $1.25. I just don't think that's likely to happen, given the amount of inventory being held right now.
Yeah, I mean, if there's a lot of latent, like demand sitting out there, sorry, a lot of latent supply at a higher price, you'll definitely see that pushback in the case of an overshoot very quickly.
I mean, one thing you have to consider as well is just the fact that the price of Ether has been going up and the over-collateralization percentage on CDPs is quite high. So people are ready to print DAI, right? It's, 430%. So,
whoa, what? The over-collateralization percent increased by 1/3 in 2 weeks?
That's what the charts say.
It's currently at 395%.
That makes sense, right? ETH has shot
ETH
up.
price ripped. Yeah.
Oh, sorry. I forgot that it was a cross-sectional state. I thought it was like dependent on the current price more so than the weighted average past price. Got it.
Sorry, do you want to continue? I think you were making a really good point.
Sorry, I'll continue. So anyway, so the point is that there is the ability for people to print DAI. If DAI was over $1 for too long, people would start printing DAI, assuming that it would go back at $1 or below $1. But right now, from my point of view, it seems like we should be defending DAI holders because as the maker ecosystem, we have to protect them. And people holding DAI, these market makers, they don't have an exit. So I don't think we should be too worried about overshooting, given that people can print DAI, but that we haven't been able to sell it above $1 for 2.5 months, like the previous gentleman was saying.
Yeah, but if you print DAI because it's at 102, but the stability fee is something enormously high, then you might not see market makers printing excess DAI to push the peg back down if it's just super expensive.
Well, market makers wouldn't print DAI because they're just holding DAI in supply. CDP holders and kind of people looking for credit are going to be printing DAI.
I'm assuming after market makers have all their inventory soaked up. Sure. But that's not an overshoot in my mind. An overshoot would be if market makers are able to unload all their DAI and then it goes above $1, which is, that's what would happen if we see some sort of exponential closure of CDPs. I mean, it's the same problem in the other direction. I'm just saying we have to be somewhat careful.
I think part of the problem is this idea that 7.5% is really high, or even 10% is really high, when we're seeing that the market on other exchanges, other platforms, the rate is so much higher than what Maker's offering. So I think that's the bias that we have to get out of our heads, that 7.5% is high. It might not be high. Maybe 18% is high.
I just think they're totally uncorrelated. I don't think we should look at them like that. I think we just need to work towards getting supply and demand to match. And right now, we don't know what the exact demand number is. We all can appreciate there's too much supply. The question is how we deal with it.
Well, the only thing is that I think the demand question is pretty easy to answer, right? Like there's market makers who are looking to acquire DAI to make markets across the board. So it's really just like shitcoin market makers that are creating the demand. So it's not like you can go out and you can pay your rent in DAI. It's not like you can use DAI in Augur. Right now, it's just all the demand is coming from liquidity providers. So I think that for the time being, while the peg is just kind of unhinged from the target price, that there should be kind of more of a focus on some of these folks who are holding big DAI bags.
Yeah,
Jordan, I'm going to jump in really fast because we're at the top of the hour and we're going to start losing a lot of people. I think that there's a impassioned discussion happening here, and I'm happy to keep on going for the people who want to stick around. But let's leave some next steps here. Those two options on the table that I've managed to record so far. It's which type of poll are we going to initiate immediately? And then there's a discussion about whether aggressive action is warranted or whether slow and steady action is warranted. So we have these two camps that we should
well, there's a compromise. There's a compromise camp there too, which is a consistent, slightly higher, but not fully, pedal to the metal situation as well.
Sure, that's a good point. So it's not everything in the world is binary. But the point I want to make is let's continue this discussion in that Reddit thread that I just linked to. And I think an interesting lower bound or upper, it's an interesting time limit is that we'll finish the discussion there, and then at the end of the day, we'll figure out what the community feels the next step is for as far as a poll goes. I think that's going to be the intermediate step, and we'll get more complex possibly for the next call. All right, so that was my speech. Stephen, did you have any thoughts you wanted to leave us with?
Yeah, just the one thought that if you guys consider the fact that everyone had really great ideas, the real challenge is, and this is off Rich's point, is we're making all these points from, we've habituated it out. We're making all these points from almost like a centralized point of view, where we've got to start thinking, how do we apply this from a decentralized point of view? That's the essence of this. What I'd love to do in some sort of imaginary world is take all these data inputs that I've heard over the course of the hour and somehow give it to some independent AI machine to come out with a conclusion for us. But in effect, that's what we've got to do from a decentralized point, is figure out the construct that we present to the community so they know which buttons to click and which ideas to implement, so that we do come up with a robust conclusion when it comes to stability fee or risk parameters and so on and so forth. So that's the real challenge here. I mean, I don't think any of you guys have a problem with the math, the economics, the concept. All of that is actually there, and it really is very subjective. It's the ability to present this in a decentralized framework that allows us to get a sort of robust conclusion. And the other thing to effectively keep in mind is the momentum of this discussion really gets pushed from this call. And to Rich's link that he's put into the chat, please carry on discussing this further on any kind of medium that you can think of, and that would be really appreciated. And on the back of that, thank you very much for joining this call.
All right, thank you, Stephen. I am fine with hanging out for a while to see if this conversation wants to continue, but I think I'm going to stop recording because it's already a lot asking people to review an hour every week. So thanks everyone for showing up. Thanks for the amazing questions and comments. As always, I'm going to be posting audio and video links soon. The transcript will be up in about 24 hours, and I'll provide a summary in that discussion thread that I've been promoting in the chat as well, so we can keep this ball rolling. All right,
I think Jordan makes a really good point in the chat.